or anyone? And basically, this presentation prepared by me, and it is not supposed to derogate or maybe say this is a good thing, bad thing kind of a thing. Okay, it is a general observation and learnings which I'm sharing. So I think we all know that RMS Titanic, okay, it was termed as unsinkable, and still it sank, and a lot of people died because of that. Okay, so there are 20 lifeboats having a capacity of 178 people, but the Titanic's capacity was actually triple of that almost. And because of that, when it sinked, I mean, a lot of casualties happen, as we know, and which has become a sort of a history, movies and all those things, and it has become a case study. Why? Because everyone felt that there was no threat to the Titanic, and it was termed as unsinkable all the time. Why? Because risk was not perceived, or risk was not mitigated, or risk was not managed at all. And that is where all the problems started. So that is where risk management is required, whether it is a life or maybe a job or maybe a company or anything, right? So that is very important. So basically, life is about managing risk, and okay, so basically that is one thing which we have to remember, that it is purely managing risk at all times. I mean, we normally feel that now risk has to be managed in special situations, and that's where we keep doing that way, but it is not like that. You have to ensure that life is managed, is managing the risk all the time, whether it is a traveling, or whether it is a going to job, or whether it is a maybe eating out. Okay, so we'll just run through a brief agenda that what we are going to cover, and let's run through it. Sorry, yeah, okay. So we'll just have a quick review about a quick overview about risk management, enterprise risk management, and we'll just touch upon these areas. Okay, so what is a risk? I think most of us knows that risk is an uncertain event or condition which may occur in the future. Okay, so which is not has happened, which may happen or may not happen. And that is why it is called uncertain event, and its probability can vary depending on the kind of a risk which is there. And depending on the kind of a risk, it may delay the achievement of an organization's or unit's objectives or goals, or it may accelerate the organization's units objectives. So it is a both way. It can be it can accelerate, or it can decelerate the achievement of an organization. And it's not certain, as we mentioned. It can be only estimated whether whether risk can occur or not. Okay. So, I mean, while we keep saying this, I mean, it's basically this famous, I will say, the cartoon, which says that now, if you cover your eyes, you can make it go away. Okay, so that is what many people think, and that is how many people also reacts to any kind of a threat which is there. They feel that now, if you hide your head under the sands, okay, like the ostrich does it, it means that threat goes away. But that is not the case. Risk management is required. Okay, so as we know that business scenario is very complex and volatile, and we need to have a very strict discipline. We need to have good management, and to ensure that now there's a prosperity is there. So at times, I mean, in some cases, there can be a legal requirement also. As I said, enterprise requires a sort of a legal risk management plan or risk management objectives. And as already mentioned, that it can be positive risk also, and it can be negative risk also. So if it is a positive risk, then you can accelerate your organization's unit or objectives end goal, and you may achieve the same thing maybe in very shorter time frame. Your vision mission can be achieved in shorter time frame compared to what now you might have perceived. Okay, and similarly, I mean, this negative events can also impact your growth. And we all know that now COVID had presented us with both positive risk as well as negative risk. Okay, and we know that positive risk was primarily whereby some companies were manufacturing vaccine like India, or maybe manufacturing some of the I'll say related thing related to vaccine and pharma companies. So they benefited from it, and at the same time the impact was on the small businesses and the big businesses, whatever, which were, I mean, badly suffered. A lot of people lost job, and still, I mean, people have not come out of it fully, particularly in some of the countries, right? So basically, risk management is required to manage this kind of uncertain events. And we all know that resources are available at all times, and therefore a focused response is required. So for the enterprise perspective, there is a sort of a COSO framework has been defined, okay, which has a different kind of a dimension. We cannot cover the all, but I'll say that from the enterprise risk management, it is defined as a culture, capabilities, and practices integrated with the strategy setting and its execution that organization rely to manage risk in creating, preserving, and realizing value. Okay, so basically, it says that you need to have a sort of a culture, okay, or practice which will ensure that the organization will be able to manage the risk. Okay, and what is the objective of managing the risk? To see that organizations survive. Okay, and it also further states that all the boards, okay, so we all are mostly, I think, independent directors, and we all have a sort of a responsibility on the board, either as a executive member or non-executive member, or maybe independent directors. So we all have a role or need to have an oversight role to ensure that the organization sustains and it creates a value in the long term. Okay, so that is what this COSO framework states in the nutshell, and boards are increasingly expected to provide oversight of ERM. Okay, so Rupali, just let me know whenever if I'm going too fast, or maybe no, if I'm overrunning it. Okay, so we have, I think, 45 minutes, right, to cover. Okay, so enterprise risk framework. Yeah.
Yeah, okay. If you're going good.
Yeah, it's good, right? Speed is okay, right? And you're able to hear me, right? Yeah,
yes,
okay.
Yes.
Okay, fine, great. So just interrupt me if there is an issue, or maybe call me in case if I lose the network. Okay, so this ERM framework has been defined by, I'll say, COSO, this framework, and whereby no, it consists of basically business planning, strategy, and execution at the same time of managing the risk. And it requires that now you identify the risk and opportunities, that is positive and negative risk. You do the assessment from time to time manner. You qualify which risks are applicable to your organization's environment or working environment. And you need to have a plan to control it and maybe continuously monitor it. Okay, so that monitoring can be done on the whatever periodic basis, whether it is a monthly basis or quarterly basis, depending on the business in which they are or in the environment they are. And at the same time, risk governance is required on the continual basis. And depending on the risk appetite and the risk culture of the company, one needs to ensure that now risk management happens. Okay, and for that, there will be a different kind of methodology, policies, and tools which needs to be managed. And obviously, that will ensure that now how the internal environment has to be managed, or how the company culture has to be managed in such a way that now the overall risk is managed in a holistic manner, which drives us towards a company's objectives in the short term, medium term, and long term. Okay, so this is a kind of a framework which is there. So the ERM framework says about having the very clear planning, strategy, and execution to ensure that risks are managed at all the time. And primarily, these are the main areas which needs to be managed on the continuous basis. Okay, I'll just pick up the laser pointer. Okay, yeah. Okay, so okay, so why implement the risk management? Okay, enterprise risk management. So primarily, it needs to we need to have a very strategic approach to risk management, and basically we need to see that now we are able to identify the traditional risk, because traditional risk will cover, I'll say, 60-70% of the risk which has been managed by the which has been observed or maybe encountered in the past, and basically to enhance the corporate governance. Okay, and obviously to strengthen the board oversight. And this risk management also helps to basically cover the new and emerging risk which might be coming up depending on the business scenarios, or depending on the new whatever socio-economical situation. So that is why enterprise risk management is required to ensure that now we avoid this whatever firefighting approach now at the last minute, and then we lose the strategic vision or strategic approach. Okay, so that is why. So coming back to the sort of compliance or controls. Okay, so there has been a different sections which has been put up by our regulatory board, Indian's regulatory board for the directors. And primarily the three sections are there, which actually guides that now how the independent directors or the board should work, so that now we have a very clear vision or clear direction for managing the risk. Okay, so basically the board of directors should lay a statement in the general meeting, and to basically indicate that what is the risk management policy, and how the identification of risk elements are being done, and how it will ensure that the company survives in the long run. Okay, so that is one of the sections 135 as per the SEBI regulation. And other one is about section 177 and the section 4, which ensures that now independent director needs to ensure the integrity and of the financial information and the financial controls. Okay, so these are some of the I'll say the regulatory mandate from the enterprise risk management, and this requires to be complied with by the directors and independent directors. Independent directors are equally responsible if they don't manage the risk in the company. Okay, so let's get into a risk management process as we had mentioned. So risk management plan requires the identification of risk, assessment, and the prioritization of risk, right? So these three are the main tasks, and then you continuously monitor and you try to control. You do the course correction over the period of time to ensure that now you leverage the positive risk, and you ensure that now negative risk are very well mitigated. Okay, so these are some of the steps which are required for any kind of a risk management process, whether it is an enterprise risk management or it is an individual risk management. Okay, so these are some of the steps, and we'll briefly run through it so that we get an idea. Are there any questions? If there are any, please stop me, or otherwise I'll just proceed. Manoj, Rupali.
There is one question which I would like to know, what are the this finance related enterprise risk, since you are into BFSI sector, so you would be in a better person to throw a light on that.
Yeah, so I think there are different kind of risk which are there, finance or strategic or operational, all the risk, legal risk, all the risk are there. And I think particularly finance related risk is to see that the sufficient sort of a cash flow is there for the sustaining the company, and there is a sufficient vision is being achieved using that whatever financial financial balance sheet which is there. I'll say that those are the primary objectives, whereby you need to see that company has a sufficient cash flow, and as agreed. Okay, so I'll say as agreed by the board, or as tabled by board, that now we are meeting those EBITDA or the margin or the NIM or whatever. Okay, so all the basically financial controls are met as expected, okay, or as agreed. Okay, so that should be the sort of objective, and any risk to meet any of this, okay, whether there's a disruption in the supply chain, then that is a risk to whatever company's finance, right? And similarly, if there's a demand which goes down, or if the I'll say if the cash flow dries up, or so all those are a sort of indirect or direct risk to financial objectives of the company.
Okay. Thank you.
Yeah, so we'll just go through the risk management plan. What does it contain? So basically, one needs to figure out how risk management will be performed, and basically what are the sort of what all it should include. Okay, so these are some of the dimension or the parameters which should be included, and we'll just run through some of the I'll say a sample or sort of a template which can be considered now for preparing the risk management plan. So basically, we need to figure out what is the kind of a risk which we are looking at, whether it's a category of risk, I can say that to some extent, there's a strategic or financial or maybe operational risk. Okay, and then we figure out that what can be the outcome of those kind of a risk, what is current treatment or action in place, and what is the sort of a rating. So when we say rating, it is like now 1 to 5 or 1 to 10. It can be as decided in the risk management policy. You can figure it out that now whether the rating is 1, 2, 3, 4, 5, and accordingly you can now take up as per the priority. Okay, and what is a basically proposed risk treatment to mitigate those risks? Are there any additional resources which are there available or required, and what is the sort of a target date, and who is the person who is going to be responsible? So this kind of a risk management plan has to be in place or has to be prepared in very initial stage to see that now we have covered all the risk. We go through the past history, past documents, and try to see that what are the risks which can occur. We also need to maybe go through a sort of a risk to the companies which are present in your sector or your domain, and try to list down or pick up the risk from the annual report or whatever from the consultant kind of a thing, and need to prepare the kind of a plan for that. Sorry. Yeah, so the very first thing is to prepare the risk management plan and have a risk register. So risk register is whereby we'll mention, take all the relevant details related to risk. It is a sort of it can be again the same thing kind of thing. Now you maybe do a little bit more drill down, whereby you say that what is the probability of this risk, what is the impact of this risk, and those things. Okay, so just give me a minute, please. I'm getting one urgent call. I'm sorry, I actually got some personal call. Okay. Okay. So basically, yeah, am I audible, right, Rupali?
Yes, sir, you are audible.
Yeah. Okay. So basically, now you will do a little bit more drill down in terms of the risk, about probability, impact, and risk reduction strategy, and your contingency plans. Again, you will have a risk corner for this, and then you go into further identification. Okay, so basically once you identify the risk, okay, or maybe you want to identify the risk, then you start using some techniques and try to figure out that now what are those risks which are there, and what is the likelihood of this. Okay, so it can be through, as I said, documentation review. It can be through information gathering technique. It can be a sort of a strength, weakness, opportunity, threat analysis, and it can be a sort of a pastel lead whereby you know political, economic, social, technical, now all those indicators, you go through it and then try to do analysis. And you can also do a checklist analysis. Okay, so all this has to be figured out and has to be done. So basically, depending on this kind of a tools, you will do a further drill down. You will try to figure out that now how the risks are actually standing, what are the kind of a different risk which may occur, and you further now document it into the risk register. Okay, so there are some of the methods, checklist analysis or whatever, SWOT analysis. Now all these things are there, and external environment analysis, which we discuss about now, that what are technological, legal, regulatory, what are the risks. I mean, so particularly as we know nowadays, companies are becoming more and more vigilant, because as we know now, if political scenario changes, then now there will be a risk, right? So as soon as the election comes, I mean, there will be a sort of companies will become more and more, I'll say, cautious in doing the projections now for the subsequent quarters, right? And obviously, everyone likes the sort of stability, and hence now they consider all these things. And obviously, again, as we know that now, environmental, ecological issues are also there, and a lot of companies are also now going down the graph. I mean, because now they are not fitting the environmental sort of a clearance or environmental compliance, right? So nowadays, some of this external environment analysis is very critical and has to be done in a very deep manner, so that now I mean, all the sort of risk are covered. And obviously board is need to ask the sort of a directors, or maybe a risk compliance officer, that okay, have you considered this kind of a risk or not? Okay, and what are the methods which you have used it to identify? Because now without this, I think at times people will now oversee, or will sort of miss out those risks. Okay, so it's very important. And once you identify the risk, I mean, you need to also go through these dimensions, figure out what is the cost and what is the time which is required. Now, all those things you need to identify. And maybe further you need to put it down in terms of, okay, how long can you do without it. So there are some of the examples or templates which are there. Okay, how long you can live without those particular things. What are the vulnerabilities which can be there? What is the contingency in case of a disaster like corona? Okay, so all this needs to be covered in a very detailed manner through identification. And then comes the risk assessment. Okay, so in the risk assessment is whereby you will figure out that, okay, what are the high risk, medium risk, low risk, okay, and what is the kind of an impact of it. Okay, so this is just an example over here whereby now we can have the sort of a probability over here, impact over here on other dimension, and then you figure out that now what is a kind of a weightage which you want to give. Okay, so here we say, for example, you give 1, 3, 5 kind of a weightage. Low kind of a risk is having the 1, medium is having 3, and high at 5. And similarly, impact of it can be listed down, and these will be multiplied and put in the grid depending on what are the kind of a risk which are there. And then accordingly, sort of a scoring system will come up, and hence depending on that kind of a risk, I mean, sort of a action has to be taken. So for example, the impact is probability is high and impact is also high. That is a very significant risk, and that needs to be addressed in a very careful or in very detailed manner, now whatever cost might be. Okay, so depending on that, one has to do this analysis to see that now what needs to be addressed. So there are some of the examples whereby you can just do a sort of a analysis about likelihood or impact and the consequences, and then figure it out that what needs to be taken care of. And you can get, as per your domain, as per your company segment, whatever, now you can figure it. You can set a sort of a benchmark that now this is extreme high risk or it is a moderate risk, and accordingly you can sort of take a take an action for it. So basically, risk items is there, likelihood of risk is there, and project if risk does occur. Okay, so those are some of the things whereby risk analysis has to be done. Need to figure out that now how you need to manage the risk, and now do the sort of a thing. Okay, so even you need to also consider that now, like if there's extreme risk, that is a safety at work, okay, or maybe compliance will regulatory impact will be what will be the non-compliance. Okay, if it is critical, so major, then now what, depending on the kind of a risk which is there, you might have a sort of a plan for it. Okay. So, I mean, on the lighter note, yes, I mean, this is like now, if you see someone who is taking a lot more care, I mean, then you know that this guy is from the risk management, right? And that's where the risk monitoring is required. Okay, and now responding to risk, okay, as I said, positive and negative risk can be in the multifold manner. Okay, so depending on the kind of a risk, whether it is a negative risk, then you need to avoid those risks. If you need to maybe either mitigate it, you need to adopt any of this strategy. Okay, transfer, accept, and maybe on the positive side, the one which are there on the right side. Okay, so they say that now, particularly for the risk response plan, I mean, now you need to delegate the liability. Okay, you never delegate the authority. Okay, so that is one thing one should remember, that now any liability, try to delegate it to someone or outsource it to someone, so that now you are covered. Okay, but if you delegate authority, you will lose that control or the power of this. Okay, yeah. So coming on to this threats or maybe a negative risk, now these are some of the strategy one can adopt, whereby you can avoid the risk. Okay, so when we say avoid the risk is by changing the project in some way to bypass that risk. Okay, that is a way you can try to avoid it. So for example, if we know that now if we take this route, okay, or maybe transport this material through this route, then there is high chances of, say, for example, some highway robbery. Okay, then you try to avoid that, right? So that is what can be strategy can be called, whereby you try to avoid that risk by taking the alternate route. Okay. Similarly, transfer, that is a second choice, which happens in many of the cases, is whereby you transfer your risk to third party. Okay, that is the insurance. So we all know that now we all take a different kind of insurance, that is a mediclaim insurance or term insurance or the auto insurance, right? So that is what is objective. Objective is to transfer the risk to a third party, right? So that is sort of a transfer strategy which many company applies in many situations. Some can be taken care of by transfer, but not all the risk can be managed by transfer. Okay, and you can also try to reduce the risk. I mean, no likelihood of reducing the risk. Okay, so basically, you can do sort of a preventive maintenance, or to see that now there is a whatever the machinery, or maybe any other thing which does which may have a sort of downtime, or maybe expected failure can be controlled. Okay, so you can try to do some kind of a sort of a preventive maintenance, or try to reduce that risk of happening, and try to see that what best you can do it. And in some cases, okay, you have to accept the risk. I mean, okay, so you can't do anything, right? So I mean, for example, recently in Himachal Pradesh there has been a lot of floods. I mean, right? I mean, so I mean, if whatever the transport if the transportation company is transporting the material from there, they would have faced the impact. So you have to accept it. You can't do much. I mean, if you have to travel, you have to travel through that route only, right? So that you have to accept it. Similarly, I mean, recently we know that in the Panama Canal there is a drought, and there is a huge backlog of ships. Around 200 ships are waiting to cross the Panama Canal.
Viren, just to interrupt, there is no, Dr. C.P. Rathore is unable to hear you. So
Okay,
I
but
just want to check with others if they are able to hear you or not.
okay,
Okay.
We are able to hear. Yeah, we are able to hear.
Okay,
So doctor,
okay,
please rejoin then. Yeah. Okay, thank you, Viren. Continue.
okay, fine. Yeah, no, he's able to hear now, right? Okay, yeah. So basically, accept is whereby now, as I said, you have to accept the risk. I mean, we know that now the ships, as I was mentioning, are crossing the Panama Canal to save a huge amount of fuels, right? And because recently of the whatever drought which is there in that Panama Canal, there is a ships are in a waiting mode, right? I mean, so you have to accept it. You can't do much. I mean, if you have to take a long route, then it will take maybe 3 months more, but and you will also burn the fuel. You lose whatever advantage of transporting the goods with whatever at a price. So I mean, these are the different kind of threats which might be there, or the negative risk which might be there, but you have to identify the strategy for each of this risk, and try to adopt this this kind of a mitigation plan. Okay, similarly, if there is an opportunity, then you need to see that how you are able to exploit or take advantage of these opportunities, right? So at times, I mean, you have an opportunity, you get a good business, but you don't have sufficient bandwidth. Then what do? You try to engage a partner or supplier, right? You try to outsource to a contractor and try to take advantage of it, or you use some technology. So that is a kind of you share at the same time, and try to have maybe some friend or some partner company, will also benefit from it, and you will also benefit from it, right? So that is one of the strategy. Second is that now you try to take a advantage. Okay, you exploit the opportunity, and now if you are the sort of a first mover, or you get into a new and emerging market, you get a benefit of it, right? And similarly, we know that now in exchange rates there is a lot of fluctuation happens. So some companies knows it, or maybe able to hedge it better to take advantage of it. So that is again second strategy. And another one is whereby you enhance this opportunity and try to see how big the positive impact can be achieved. So for example, we know that now because of the COVID, a lot of companies has moved out of China, or rather they are going for +1, and we know that Indian government is trying to take advantage of it, enhance it, and by offering a lot of I'll say benefits or subsidies and production link incentives, right? So now that is helping to enhance that opportunity, whereby now companies are looking for alternate, and the government is trying to take give the sort of a long rope to the companies who wants to move to the India, right? And in some cases, it's a reject, whereby you can't do much. You know that you might benefit from it if you do this or that thing, but then you reject that opportunity and you let it go. So in some cases, we know that now company has a lot of business, but they will say, no, I'll only go for the most profitable product business, or most profitable customers, and I'll not go for some of the low margin customers, even though this might help in the long run to have more logos on their whatever list or board, but still they might reject this operation. So there are some of the examples which I'm just sharing with you now, that once you identified the sort of done the identification of risk, you've done the assessment of risk, and then you will start preparing the response plan. Okay, risk response plan. So that is in nutshell about how you will prepare the risk response plan. So these some of the examples which I've mentioned, and at times even the response is one part of it, but then there is at times also again a second level of mitigation is required. Okay, so even though you might have taken the whatever response to either exploit or maybe take advantage of it or to mitigate the negative risk, you need to also have a second plan, a contingency plan, to see that if the main the mitigation or the objective fails, then what you will do. So that is again a sort of a strategy several companies adopt, whereby it's like plan A and plan B kind of a thing, and they take advantage of it to see that the opportunity is not lost, or the negative risk is not having a I'll say vast impact on the company. They try to reduce the whatever impact or take advantage of the situation, right? Yeah, so and once the risk monitoring is being done, then obviously risk tracking is required to be done, whereby now you continuously figure it out that what was the risk response and what is a high level impact which has posed. You might be doing this kind of a tracking, whereby you'll say that now what was a risk in this month, and what was a risk level in this month, and what was the risk level in the last month. Okay, so you can have this kind of a, I'll say all the risk items which are applicable. You might keep preparing the ranking of those risks, okay, and you keep comparing those risks. Okay, so if there is a say for example some of the risks are moving up or moving down as per the ranking. When I say means it's having a more impact, or it's becoming the worst kind of a risk, then you need to figure it out since how many months it is at a particular stage, and then you try to maybe rework your risk response strategy and try to have a risk resolution to manage those risks. Okay, so this can be a sort of a strategy. In some cases, some companies adopt this, they continuously monitor it, and they do a sort of a course correction at different point of time. Okay, so we know, as we have several cases, we know that now like leadership particularly, right? So some of the big IT companies were having the leadership issues, and then it was sort of a CEO or MD was appointed, and then there was an issue for whatever few months, and then again another CEO was appointed. So those all kind of issues can occur. This can be rated as some of the major risk, and after monitoring this risk for continuous whatever few months, then maybe a board needs to take initiative to see that now how to counter manage this kind of a long running risk, which may have impact on the overall company's vision and mission. Okay, so risk categories can be different in different companies, and it can be further categorized into depending on the segment of the company and the domain of the company. The segregation can be different. Okay, and there are some of the I just listed down. As I mentioned, if for financial, it can be a funding issue, it can be a capacity issue. Okay, operational can be a availability issue of the manpower, and which we know that several companies have been facing it, right? Strategic is whereby customer retention, the customer reputation is required. Okay, so these are the different kind of risk identification methods which one has to use it to figure it out that now what is the risk level and what is a sort of a strategy to be adopted. Okay, as I said, internal risk can be a different kind of a thing, external risk can be different, and one needs to manage it very carefully. Okay, So again, as Rupali, you were asking it, I mean, this financial risk, as you can see, can be this interest rates or exchange rates or maybe asset loss or goodwill and amortization losses, right? So all these are kind of a financial risk which may occur. Okay, so goodwill losses, I'll say I mean, it is a financial risk because if you lose the goodwill, then no one is going to buy your product, right? And hence it is sort of going to have a huge impact on your financials, and it's really going to badly impact. We know some of the cases, right, like whereby companies were having a quality issues, and then they lose the goodwill, and people now move to a different product. Like we know Maggie, right? I mean, Maggie was found to have a lead, I mean, few years back, and then the sales literally dropped, right? And the people lost the, I mean, the company lost the goodwill, right? And as a part of that, I mean, many other companies took advantage of it, and new kind of I'll say, noodles which came into market, they took advantage of it. I mean, it was a negative risk for someone, but it was a positive risk for others, and they took advantage of it, like Top Ramen and others. Now they captured the good amount of market share, right? So these are the different kind of a risk which keeps coming up, or may one needs to continuously monitor it to see that now they are well covered, and the company is not going to have an impact on a long term.
Didn't we have two questions in the chat box?
Yeah,
So
sure.
okay, I'll continue. Okay, first, Mr. Uma Shankar is asking, how are the transferred risks are traced so that no transfer does not increase the risk during the course of operations, while the risk committee may meet once in 6 months to review, which may slip away the timely assessment. This is the first question.
Okay, so see, basically, depending on the kind of a company domain segment, okay, risk management policy will be defined or framed upfront. Obviously, there will be a revisions, multiple revisions, which will keep happening from time to time. So, as a part of that, I mean, risk management committee may meet 6 months or may meet 3 months. So, depending on how critical the risk might impact the overall operations, it's quite possible that the committee may meet maybe at a shorter frequency than maybe at a larger frequency, right? So that is one thing. And second is that now, depending on the kind of impact which the perceived risk may have on the company's operations and the financials, the company may have, or rather the risk committee may have a sort of a plan B, okay, in case the transfer risk may fail. Okay, so that can be a sort of a strategy which may be adopted by several companies to mitigate or to handle the risk.
But what is the frequency of these meetings? Because Sir has said it's 6 months to review, once in 6 months. So what is
no, so there is no as a defined thing that now it has to meet once in a 6 month. Okay, so the working committee may meet maybe a monthly or maybe even a shorter frequency, depending on how much impact it can have. It can be also maybe 3 months, but maybe board might be steering committee might be meeting maybe at a higher frequency or lesser frequency now, whereby the risk committee may present the report. So I mean, there is no basically defined thing that it should meet at 6 months or it should meet only a year. It all depends on the company's strategy, policy, and the requirement on how frequently they need to meet.
And there is one more question, Viren, from Uma Shankar only. What are the
Yeah.
popular tools used in ERM, while many companies just use MS Excel?
Yeah, I think most of companies are used to using the Excel only, and they are managing Excel. But it all depends on the, I'll say, PMP, project management, portfolio management tools. Okay, so they have sort of a risk management as a module, which mostly will be access will be available to limited people or key stakeholders, and the risk will be traced over there. So maybe I'll show you one maybe a document. Maybe give me some time once we reach one, or maybe just hold on. I'll just maybe try to share the screen. Just give me a 2 minute. Now, so basically, how it is being managed, it can be. Hold on, please. I'll show you. So every company has a different kind of, I'll say, method to manage the sort of a risk. Okay, so 1 minute, hold on, please. Give me some time. I'll just maybe towards the end, I'll just find the document and we'll share it over here so that now people are able to see. 1 minute, hold on. I'm not able to find that document. I can show you that document now. You will get some idea that how the risks are being managed in some of the cases. So then you get some idea. Okay, just give me some time. Maybe towards the end, I'll show you. But yeah, just Rupali, just remind me towards the end of it. Okay, I need to find that
fine.
document. Yeah. Okay.
Yeah.
Okay. Shall we move forward?
Yeah, sir.
Okay, so as I had mentioned in one of the earlier slides, risk tolerance or risk appetite it is very critical. So some companies are having a very high risk appetite, okay, and high risk tolerance, and hence they take a sort of I'll say they basically they say na khatro ke khiladi kind of a thing. Okay, so they take a lot more risk in terms of now something goes wrong, and depending on the company to company, the different strategy can be adopted. So if companies, I mean, many startups, as we know, are having a very high risk appetite, and hence now they do a lot of things at the same time. They might not have maybe a proper governance also, but because they are a small company, they take a lot of risk, and hence they have a lot more risk appetite. Whereas now if you see the established banks or established company, they'll be very risk averse, right? So in those companies have a very low risk tolerance, and they will ensure that now the no risk should have a very any impact on the long term sustenance of the company, and hence now those companies go very slow in terms of their execution, expansion to the new geography, new product, all those things. And unless and until they are not confident, they will not move to different geography, different territory, or different product. Okay, so depending on that, it all depends. So as I said, it all depends on the kind of risk tolerance and how much impact it may have. There can be a different parameters by different companies, different sector, different segment, whether small, medium, large company, and accordingly they will see that now they take care of whatever risk mitigation. So some company may not have even the risk management policy. Why? Because they are very much having a large risk appetite. They have risk tolerant, and they are ready to face the issue. Because if you want to have a risk mitigation plan or risk management plan, then there is a cost involved to it, right? So many companies, small companies, I'll say that particularly, they will try to avoid having the risk mitigation plan to ensure that it does not have impact on the profitability. Only when they grow the large, they are bound by the regulators, then they will start having the proper risk management plan. And that's where, even for example, RBI, they are very strict with the banks. So now the tier 1 banks, they need to continuously see that what is the kind of provision which they have done it. And nowadays they want to maybe have these details on the real-time basis. So basically within T-1, they are expecting that now the provision should be visible, or NPA should be visible, and they don't accept. In the earlier days, they used to prepare the NPA reports after 15 days or a month. I mean, so nowadays RBI is very strict with them, and they try to see that now I want to see the report as of yesterday. Okay, so and in case if they don't meet those kind of requirements, then they leave with the penalty. So basically, RBI's risk tolerance with large banks is very less, and hence banks are also very cautious. They try to invest a lot in the technology and all those things to see that now they are able to produce those kind of reports. So basically, and hence, if you see, I mean, recently when this Silicon Valley Bank had an issue, it fell. Then initially there was a knee-jerk reaction in the stock market. People were thinking that it will have an impact on the Indian banks also, but there was absolutely no impact on the Indian banks. Okay, so why? Because the kind of risk tolerance by RBI was very low, and they ensured that no, there should not be any impact on it. They have made us such a huge, changes in the policy, to see that now exposure should not be more than so and so percentage to a particular corporate group, or maybe to particular sector domains, and all those things. So because of those kind of things, the banks were not having any impact on the because of the fall of some of the US banks, right? So again, as I said, depending on the likelihood and impact of it, stakeholder risk appetite will be there, and accordingly they will take some things. Okay, so basically on risk management tools and practices, we have more or less covered, but this is what is expected: risk impact analysis, probability impact assessment. All these things needs to be done on time to time by a risk committee, and need to continuously monitor depending on the cost, time, and quality of those risks, and figure it out what needs to be done. Okay, so continuous basis risk impact assessment has to be done, and needs to be monitored. All the risk mitigation strategy has to be in place. Need to see that now how the risks are being managed, and what are the plans. Okay, so there are some of the examples which I'm just showing to you, and one needs to figure it out that now what is the probability of it and how it can be now managed. Okay, so some companies does this way: what is the probability of it and impact of it, and accordingly, depending on the score, they will take care that now how much whatever management is required, how much mitigation is required. Okay, so I think I'm almost done. I just maybe sort of show you some of top global risk in 2023. So there are some of the top risks which are there as of early 23. And we know rising inflation is having an impact everywhere. Energy supply crisis were there in initial, I'll say, part of year because of the Russia-Ukraine issue. But I think now it is more or less in control. Obviously, because of the inflation, cost of living is again sort of a crisis is there, and remaining things are there. But yeah, this is how the normally the overall global risk are mentioned. Okay, so there's some of the pointers whereby now you need to involve all the staff and management. So whenever you are doing the risk identification, you don't try to just say that okay, only the key members or senior management will do this, because people at the ground level exactly knows that now what can go wrong, and it is better that now we involve all the people and in the hierarchy or in the chain of command to get involved, and we should not punish anyone because that they are highlighting some of the risk. Okay, so which is some of the practice in some of the companies whereby they are not ready to accept the risk. Okay, and hence whoever says that are being ridiculed, saying that no, this cannot occur. Okay, so one needs to very clearly note down all the risk which can be there, and focus on having the plan to manage those risks. Okay. So normally, many cases it fails because of some of these reasons whereby people are not ready to engage all the stakeholders, as I said, and at times people are not ready to accept that this risk can occur. Okay, so that is what causes the issue, right? So I think that is more or less summary from my side. Okay, so I'm
Mirin,
almost
there is one question. See, how are the carbon net zero risks being looked at, and how are the industries addressing this?
Okay, that's a good question. So I think net zero objective, which has been laid by, I think, all the world leaders, WHO and all those, not WHO, but I think UNICEF or United Nations, has been, yes, I mean, it's a very significant risk that we may not meet it. And already, if you know, or if you have noticed, many companies, many countries, okay, so for example, in the Europe, many companies have started levying the tax on those companies who are not meeting the carbon footprint. Okay, so reducing the carbon footprint. So a lot of countries have started doing it. That if it has been not done with whatever carbon neutrality, then they'll be punished by levying some tax, or they will stop importing things from those countries or those companies. So that is how they are already, European countries have started imparting it, and hence a lot of companies and countries have started working towards a net zero thing.
Okay, I believe that answers your question, Vijay Lakshmi. And so there are two more questions.
Sure.
How off balance sheet items like contingent liabilities are expected to yes, please.
Expected
Are expected to be traced from ERM framework perspective.
Okay, so I think it's difficult to, I mean, to be very honest, I have not came across this kind of thing, but yeah, I mean, it's very difficult unless until the stakeholders at all levels come together for brainstorming. Okay, so some of these techniques which I had mentioned for identification of risk, I mean, there are several techniques which are there, and unless and until all the stakeholders at all levels sit together and now do the brainstorming in terms of now what can be the different risk, I mean, which may not be on the balance sheet but off balance sheet, then then only it is possible. Okay, otherwise I think it's not possible to track or identify it. And some companies are whatever you can call it, unethical or illegal or whatever, they try to avoid those kind of things. Okay, because there might be a sticky issues, and may addressing those or meeting those things may have an impact on the overall I'll say profitability, because once you identify those risks, you need to have a plan for it, and that is a board's responsibility. If you don't manage those, then you will be sort of have a problem, right? So it's difficult to identify or difficult to say that it will be managed.
One last question, Dhiren.
Yeah.
How are the non-tangible risks like reputational risks, cybersecurity risks are quantified?
Very good question. So I'll say that see, all cybersecurity risk comes under technical part. Okay, so that is one, and I'll say goodwill risk may come under financial or maybe a strategic thing. Okay, so from the quantification perspective, I mean, there are several companies who does the sort of evaluation of the impact of it. Okay, so by comparing with the peers or the similar companies, now that say for cybersecurity, I mean, because now everything is technology driven. So if the company is whatever systems or technology, I mean, servers are hacked, I mean, then company comes to standstill. Okay, and we have recently noticed some of the similar issues in case of some huge airlines and huge company, I mean, corporates, and it was not very clearly came in the news also, but there was a huge impact because of those kind of things. Okay, and it is purely based on I think evaluation done by some of the consultant companies that now they will figure out that what kind of impact or quantification is being done. So it is very I'll say very subjective, that depending on where they stand in the market, how much market share they have, how much goodwill, in the sense ki how much trust people have on that companies, the quantification can be done. Otherwise, it's very difficult to just using some formula, it can be done.
Yeah,
Okay.
so that's all the questions we raised in the chat.
Okay.
And yeah, you have to find out that popular ERM tool.
Yeah, so I'm just trying to just give me a minute only, that how it is being done in some of the companies. Okay, so I just 1 minute.
Yeah,
I'll just
so
yeah.
Kiran, I'll take the control from you, because I'll be talking about our this thing initiative, and then give the controls back to you.
Yeah, sure. Just give me a couple of minutes. Let me
Yes,
try
you
to
let
find
me
out.
know. I'll
Yeah.
I'll share my screen.
Yeah, please.
Okay, for everyone who has joined us, no, aspiring independent director and serving independent directors. So these are the offers we have. If you join our membership, please do join our WhatsApp group. It's the QR code is already shared with you. So what we are planning, like first point is the fortnightly webinar with industry solvents. And in this, we also give you an opportunity to talk about your area of expertise. And once we have this community, we all together help each other getting the opportunities for ID and discussing what all opportunities are available, because even in writing the resume for ID, there are some specific pointers or words we have to pick in. And also the third point is we plan to have a physical meet, four physical meet in a year and one free in a year. So 4 physical meets in 1 year. That is what we propose to. And this an opportunity to network. Also, in addition to that, we would be sharing the recording of all the webinars, give you the visibility to industries. We together will form a community to give the visibility to industry to each other. And also you will be getting the weekly write up, whether it's we have this thing on WhatsApp group, it is shared on LinkedIn also, we'll share discussion on case study. That is the third last point. Is there are lots of cases related to corporate governance and related to audit committees, which we would be highlighting. And also we give support in passing the ID examination, IICA, and we also simulate the board meetings. So these are our plans. And we also offer, because we want to build a community. So membership of nominal charges of membership, that is 199 for a year. And there is no hurry that you need to join it now. You take your time, decide, but you get all the benefits, what we have written here, we offer once you become a member. And these are our products also. It's focusing only on independent training. For members, we have kept it at 4999. You for details, you can get in touch either with me or with Manoj. And if you if you decide not to become the member, then the charges are little higher. It's 7999. And the duration we plan to complete as of now is in 1 month. And during that 1 month, you will get all the support from us. So this is brief from my side. Manu, if you want to add something, please do that. And one thing, next session we are planning to have on 9th of September, which is related to CSR. And we have invited a speaker who is doing the CSR audit for various companies. Manoj, you are on mute.
Yeah. Thank you, Rupali. I think we have covered all the points. So again,
Manoj, you are not audible.
Yeah, now it's okay.
Yeah, better.
So I think you have covered all the points, right? So now audible, no? I am audible?
Yes, you are audible.
Yeah. So I think again, I will request all to, I think, promote this. So you will be getting a good benefit, and we'll be working little in a different way, so that we can get a visibility as well as some the ground reality knowledge. So whenever we go for an interview, so we can get a better success, right? So thank you, and thank you, Biren.
Biren is supposed to share one document, and this the where my cursor is, it's our QR code for joining the WhatsApp group. And any queries, you can get in touch with me. And Biren, I hand over to you now. I am stop sharing.
Yeah. Sorry, actually, I couldn't find it right now, Rupali. So I think
Maybe
I'm sorry.
you can share later. So I
Yeah.
can know later on, I can share with Uma
Sure.
ji.
Sure.
And Viren, it's always been a pleasure to listen to you. And you have beautifully mentioned that it's a culture, it's a mindset, it's an attitude. Yeah, so and
Yeah.
the focus for corporate risk management, or I think for any other field also, it's how it's organization to sustain. And the
Correct.
ERM framework that you have explained, no, all the steps. Yes, once the framework is with us, then no, we can ourselves drill down and understand what goes into it. And POSO framework, which I was not aware of, I'll definitely go through it and see how no, it's enterprise, how it relates to that board thing. And skill sets, I wanted to ask you, like, what all skill sets should I have if I know see myself joining a board as or not joining a board myself to be onboarded as ERM consultant. So what all skill set do I have? Maybe I can get in touch with you to find it out
See,
what it is.
yeah,
Yeah, yes.
yeah. So see, one of them is I'll say MBA is one of the qualification which normally covers some aspect of it. And apart from that, there are some risk management certifications from different companies. One of them, like companies, or rather, I'll say institutes. So PMI is one of the institute which is having the risk management program no, certification, which covers risk details to a very granular level. Okay, so that is again another certification. And again, otherwise, it's more of a project management, no, having a more insight into risk is sort of, I'll say, prerequisite to get into risk management role or ERM role. Yeah, so that is how normally it is. It is more of a, I'll say, a PMO kind of a role, which gets very specific to risk management or ERM, and then one can get into that. Yeah.
Okay, Viren, is there any benchmark for risk by like no when we say supply chain, it's always Amazon, it's always no those companies. But for benchmark of risk management, enterprise risk management, do we have or all the banks? I know that all the banks have good risk this thing, but something to or within not now maybe can you if possible with you you can share few of the
Yeah.
links no which we can share it with the participants who all have joined today so to
Sure.
get a better
So,
understanding of that.
sure. So normally I'll say benchmark wise, I don't think that there's any kind of a benchmark. But as we know, some of the analyst company, they rate the these corporates now with the ratings. Okay, so that ratings like CRISIL itself rates the companies on the whatever triple A plus or BBB, right? So all this actually indicates the kind of a risk which can be there. So anything above double A plus is sort of a safe company, and anything no, below that maybe sort of attract some kind of a risk to it. So that is how it normally done. Different industry may have a different framework, but this is how the risk benchmark you can consider it no, from the whatever evaluation process. So whenever you are investing into any instrument or any kind of a company, you need to just figure it out what is the risk rating of that company, which has been given by different this kind of a ratings company, which is like CARE or CRISIL or S&P, Moody's, Fitch. So they all do the ratings of the corporates or SMEs. Okay, and hence you can use that as a sort of a guiding tool for figuring it out whether to invest into this bonds or this FD or this thing. Okay, so that is how it can be done. Yeah.
Okay, thank you Viren.
Okay, sure.
Yeah, so there is
Thank you
no
all for joining.
further questions. So thank you everyone for joining the call and joining the session, and thank you Viren for your time and accepting the invite. And for others we look forward to talking to you. Please do connect with us. You have our WhatsApp details, you have our LinkedIn details, and our myself and Manoj details also.
Thank you.
Yeah, thank
Thank
you.
you. Bye.
Thank you. Bye everyone for joining. Manoj, anything you want to
Thank you,
add?
Viren. Yeah, thank you, everyone.
Thank you,
Thank
dear.
you. Bye.
I think we'll end the call, right?